Hello everyone, I'm Dr. Stock. Today I would like to take a look at the markets, see what we've been going through recently, compare that to a longer time frame to see what's coming up, also talk about the stimulus money, the interest rates that we have, and really just what I see going on with the market now and in the short term and throughout more of 2021, and also just a couple of stocks to track the action, talk about some of the trading that I've done recently, and just love to share it with you guys. So let's get ready to rock. Welcome back. For those of you who are interested, down in the description is a link to my Patreon. You can head on over there, and if you'd like to join us, if you'd like to sign up to see the stocks that I'm trading in, to talk with the community that we have over there. I know I saw in the conversation in the Discord throughout this week that people are glad that they have those supporters there, and the supportive community that you find, because people are despairing, because when we look at that emotional curve that we have in trading, when you get to the bottom, people, they want to quit, they want to be done, they want to be out of the markets, and really that's where we want to be buying if we really find that we think that we're towards the bottom, or when we have those sell-offs, that we can go ahead and buy into those things. And we have a lot of strategies for mitigating that, but I gotta say, the support that I see in that community, it's been wonderful this week. I'm glad to have them there, and it's nice to see everybody coming together. So besides the supportive community, I also have my growth portfolio you can take a look at, and being a growth portfolio during this time when we're facing those inflationary fears, boy, has that gotten roasted, but I think it's going to have a lot of promise going forward. It is a long-term thing. The dividend portfolio has been doing all right. They're older, they're more established companies. Some of them are more accommodative to growth, and with the bank stocks that I have in there, those are even accommodative to the idea of inflation. So, that one's been doing all right. So if you want to check those out, links down in the description for Patreon. I better move on. I ramble too much sometimes. Also down in the description is a link for Webull. If you click that, sign up, deposit $100 into Webull, you get 2 free stocks for the sign up and the deposit. I get 2 free stocks for the referral. It helps us support this channel, and the support's been wonderful so far, so thank you everyone who's done that, and thank you everyone who has yet to do that. I really appreciate it. Finally, if you wouldn't mind, hit the subscribe button, notification bell, like button, share it with your friends. Let's get on to the stocks. Alright, so here's the one day for the Dow Jones, and you can see that things got a little bit rough from the time that we opened okay, but then we had a sell-off, we had that dip as the bond yield went up. I think it was like 1.626% or something like that it peaked at one point in time before coming back down a little bit and settling for us. And then after that, we had the jobs report come out saying about the jobs that were added through the month of February, which is a pretty good report for us. I'll get more than that soon. And then, it was a pretty nice day through the end of the market. And if we take a look at that over the 5-day, you can see that big jag down that we had in the middle, and this is really when people started despairing. And the Dow Jones, actually, at the 3 major indices that we have here, it really, in my opinion, has taken it the best. Even if we look at the 1 year to really see how it's gone, nothing really looks out of the ordinary with the Dow Jones when you come up here into February and March for the Dow Jones. If we go over to the S&P, here's the 1 day. It looks very similar to what we had with the Dow Jones. If we go up to the 5-day, you'll notice this one turns red. It took finished a little bit lower in those 5 days than it did for the Dow Jones. And if we look at the 1 year, we can see sort of this rounding off that we have, that we kind of lost that bullish momentum that we had a little bit with inflation fears and the interest rate yields, and then also the jobless claims that we've had and the slow economic growth. And so with all that piled on, it's been, for the S&P, not necessarily the greatest thing that we've had. But you'll notice, despite the fact that it's been a sell-off, that it's been rough, that it's only a little bit out of the ordinary for what we saw before. It probably, for the S&P anyhow, it sort of compares to what we have back here in about the middle of October or so, although it's a little bit more rounded off that we have for this sell-off. And, you can see deeper gouges out of the S&P within the last year. Finally, the Nasdaq, the one that's taken it the worst out of the 3 so far. Again, very similar shape over the 1 day. We look at the 5-day, and you can see it has a much lower finish than the Dow Jones or the S&P did over the last 5 days. And if we look at the 1 year for this one, you can see that we had that curve and that we had a bigger drop out of the other 2. So this is really where we saw a lot of those sell-offs taking place and a lot of big impacts happening through the Nasdaq. Just a quick look at the VIX over the 1 day. It's red, and that's something that we want to see for those prices evening out, less volatility in the market. And if we go to the 5-day, you can see the spikes that we had, and these are spiked up where we had the dips down in the major indices, where we had those really deep dips. We went down and then we sort of recovered a little bit, and that's something you want to keep in mind when you do watch the stocks take those really deep drop-offs that they have, the really big sell-offs. There's usually a bounce that follows, and you can take advantage of some of those things. Also, you can dollar cost average down, and I'll talk about that when I get over to the stocks a little bit more. Just a 1-year look that we have at the VIX. You can see it started moving upward, that it didn't really have that downward slant, but it's still well below where we had it at the end of January. And you can see throughout the year that there are other spikes that have taken place. So these spikes are temporary. They don't often happen very long. You can see what it looked like back here in March. That was a very, very deep dip in the market with the pandemic hitting us and then slowly tapering off as time went on. All right, just a quick look through some of the stocks that people have been wanting updates on, especially as we see these big drop-offs, and especially if they're people who bought in at the top. This is Senseonics, ticker symbol SENS, and when you look at it, I mean, you can see, let me turn off the RSI and the MACD. There we go. Now we can get a better view of the graph. So when you look at this, just dropping off as much as it did, we're down below half price from where it was at its peak, and maybe that was a little bit too much too fast when we have those ramp up periods like that. But now I think we're getting back into more reasonable territory, especially for a company that has FDA approved products, and it's working on FDA approval for its 180-day, which I've talked about before, liking that better than the 90-day implantable. So if you haven't seen that, check some of my old videos for Senseonics, read up about the company, see what you think about it. I still like this one. I like it a lot more at $2.48 than I did at $5 because I think there's better buying opportunities, and I don't know that we'll see it drop a whole lot more from where it's at now because we're starting to get more to reasonable levels. Bionanogenomics, you can see similar shape, similar story. Again, another spec play, another growth play, and we have that same drop off here about the same time that this one peaked at almost $16 per share. Was the same time Senseonics peaked. And so this is just to show you that it's not necessarily company specific, it's more categorically specific. That what we're looking at is, again, a company that doesn't really make the money to merit the stock price that it has. Instead, it was more in the fundamentals of the company and what the stock could be worth in the future. That was all priced into the stock, and with the recent market conditions and the fear of inflation, you have the money rotating out of that and into other areas of the market. So we have these sell-off periods, and now we're starting to get into more attractive prices. So maybe $7.15, which is what this ended at market close. Maybe that's more of a price that you would like. Pretty much everything in my growth portfolio is a long-term hold. There's a few of them that I consider shedding some weight on, that I just go ahead and get rid of them, take the tax write-off, so that way I have the cash flow if I need it in order to put it into some other areas. Right now I still have some cash that I'm willing to put back into it, especially at the prices that we see, and so I did make some purchases today. Here's another tiny one just to share with you. So ABML, working on battery recycling, I believe, and that dropping down below $2 a share. I think that we're starting to see where about the bottom's going to be for this market and for the sell-off, that we're starting to get to those prices where we don't have as much of a drop, but it certainly has dropped over time. If this does drop down even further, I'll probably grab a few more shares on it just to lower my cost basis, so that way it's not so hard to make a profit. So I think that my original position was somewhere around $3.60 a share, and buying in this, I think I bought in at about $1.80, so at 50% less than what I bought it originally. I didn't buy as big of a position. My plan instead is to just dollar cost average, so if this keeps on moving downward, I'll keep on moving downward with it and keep on lowering my cost basis, so that way when we do see that growth come back in to these companies, that we also see it come up with it. This being a smaller company, a much riskier play, it's not one that I'm going to put a ton of money into, but it's certainly one that I would like to lower my cost basis, so that way it's not as difficult for, as it comes back to strength and as it comes back to popularity, the growth stocks in general for that matter, that this can go right along with it. Okay, again, another small company, similar shape. I bought a few shares of this one as well. I like this one under $4. And if you take away that steep ramp up that it had where it went up over $9, we're actually running at a fairly good line right now from where it was at. And I think, as far as correction goes for this one, I mean, yeah, you can say that this one crashed most definitely because it's down over 50% of its value from where it was at its high. And it was pretty much a straight run down just for the past couple trading weeks. And so now I think that we're finally starting to even out a little bit. I think we're going to level off a little bit. I don't know that we're going to have these prices fall a lot more. All right, another company that I picked up today was Open, and they got double whammy. Not only did they have the market conditions against the tech stocks and the sell-offs, but the other part about it was their earnings weren't as strong as expected. And so with the earnings coming out and the downgrades that they got in their price targets, mostly down to $30 a share for a 12-month price target, I was able to take on a couple of shares of this, and I think it brought my cost basis down to about $23 or so. So at that amount, I still have a 30% upside to those 12-month price targets. And the three companies that I saw, Oppenheimer was one of them. I can't remember what the other two were. They all maintained. They all kept their ratings to outperform on the stock. So as we come out of this sell-off and as the tech companies and the growth plays start to bring that money in, plus in my mind this is a real estate play as well, even though it is tech. With that relationship, I think that this one's going to crawl back out of the gutters, and I think that we're going to see more strength come into its stock price, and I fully expect to hit that $30 price target within the next 12 months. All right, the last stock that I have for you is Skills. Seeing Skills under $30 a share is something that I was excited about. I think I ended up picking quite a few more shares of this actually yesterday for my own personal portfolio. This wasn't one that went into my growth portfolio because I used it from a separate account, just because I had some other money that I wanted to throw at it. So when I did, I think I got it around $26 a share or so, and it's already up to $27.45 at least for the close. If we look intraday on this one, let's find out what happened. Okay, when we look intraday, we actually find out that in the market close that it actually made it up to that $28 per share mark. So with that, I'm already up a couple of percent already just on my money, and I don't think that we're going to see that price be kept down for too long, because right now it's a spec play and it's a growth play, but I think that it's growth that's going to be pretty well guaranteed to us with the e-gaming market that we have and the esports market that we have. I like their business model. I think it's great. I think the NFL being part of that, when the fall comes around and we start seeing evidence of that deal, that partnership takeout with the developers that we have making the games, and I don't know if they released details about that partnership yet, but it's something that I would like to read about. And that deal with the NFL, I said before in some of my other videos, I think it's a foot in the door, company-wise or partnership-wise with Skills, that other companies, if they see the NFL's success, if that's a successful thing and other big names get on board, we're going to see a lot more activity going on with Skills as we go forward. So it's definitely a company that I'm watching, one that I really like, and as much as I'm not glad to see the position that I have decrease in value, I was glad to have another buying opportunity where I could dip in with some of my other funds in order to access a few more shares that could get some more exposure to this company. All right, so let me summarize. The growth stocks, the spec plays, the money's just not there right now. It doesn't mean that the money won't come back into it. These prices they can't drop forever. As a matter of fact, statistically speaking, they don't drop forever. We have sell-offs, we have corrections, we have crashes in some areas. As with the growth stocks, there's a lot of different places that crashed, especially the EVs would be one place. NEO under $40 per share. That would be, that's just incredible to see. I have a position NEO. I'm really, really, really tempted to put in a larger stake in a NEO. If I wasn't already so heavy into some other EV companies, I most certainly would take a larger position there, but really it's about risk management. But I have my largest holding out of the EVs is NEO. So I'm already pretty well invested. I think I'm at about $45 a share for that. If I wanted to dollar cost average down with it, I would also do that. But like I said, I'm already pretty heavy there, so I want to manage my risk a little bit and be careful not to put too much into any one company. If you're looking for areas to invest in, look for energy stocks. Those are doing pretty well right now. Bank stocks are also holding in there. Those are any sort of recovery play that you would have. So travel stocks or any of the leisure stocks, ones where just that pent-up demand from getting out from under these pandemic conditions. As we see, I mean, AMC is opening up its theaters in New York. I forget exactly when, if it's tomorrow or if it's this coming week. It's really soon, and they're also talking about opening up again in LA. So I think that that's going to be a big sign to watch that open, and I think that we're going to have a lot of other companies following suit, and travel bans are lifting up. So watching that unfold, that's going to bring further strength into these recovery stocks. So cycling your money into those recovery stocks wouldn't necessarily be a horrible idea. It's something that shouldn't crash on us anytime soon. As a matter of fact, the pent-up demand should be something that propels us forward. As a matter of fact, it might help us with the recovery of some of our own cash that we may have lost with some of the growth plays. If you're somebody who sold off on those, or if you're just looking to move your money somewhere else, that might not be a bad place to go until after we get through a little bit of the through a little bit of the rocky period that we have right now with some of the growth and spec plays, especially as we have easing fears of inflation and the financial tightening, if you will, as those fears go away, as that money comes back around, and it will, because you're going to have all those other stocks, all the recovery plays, they're going to be overvalued at some point in time, and then that value is going to be played out, and so it's going to go into stocks of bigger value. So by then we should have more mature growth play companies anyway, with bargain bin prices possibly still at that point in time, and then we can always we'll see the money go back in there, and then we'll watch surges go throughout the different parts of the market there as well. So that's what I have for you today. If at all you're interested in my Patreon, the link's down in the description. I would love to see you over there. Also, that link for Webull, sign up, deposit your $100, get your 2 free stocks. That link's down there as well. Finally, subscribe, hit the notification bell, hit the like button, share it with your friends. Remember, this video is for entertainment purposes only. Always do your own research and due diligence. Contact a financial advisor before making any financial decisions. I'm Dr. Stock. Thanks for rocking with me. Now go get that money.